Well, one company, I did a quick, kind of like we would a Your Stock, Our Take segment, because there's one company on there. It doesn't fit our full criteria yet, but Brennan will have some comments on it because they are in the diamond industry, loosely speaking, not loosely, they're in the diamond industry, and it's Brennan's little pet favorite, that industry. So why don't I just look at this company? We interviewed management there, and we'll go through it like some a viewer asked a question. So the company's called Adamas, One Corp. Symbol is JEWL, or JEWL on the NASDAQ. It's about 77 cents, $16.3 million market cap. So a true micro cap company. They are a lab grown diamond manufacturer and producer of nearly flawless single crystal diamonds for gemstones and other industrial applications in their facility in Grenville, South Carolina. The company holds 36 patents and uses its proprietary chemical vapor deposition, or CVD, to grow gem-sized and smaller diamond crystals. The company's diamonds have the same physical, chemical, and optical properties as mined diamonds. So let's look at the balance sheet from the last period. This company just listed in December and has had share price go down precipitously over that time. But I'm going to look at the balance sheet, then we'll get to where the share prices come. As at December 31st, the cash was $3.46 million in the bank. Total current assets are $5.32. Total liability $7.13. So there's a working capital deficit right now of just under $2 million. It's not something we like to see, but not completely alarming right now. So the stock price, like I said, is down 83% since it started trading in early December on the NASDAQ, just around 5 months ago, at $4.74. It's currently at 77 cents. Why? Well, I would say generally the environment for speculative small caps remains poor, but the valuations in December were high given the lack of significant revenues and what we would just call proofs of concept through sales. Ultimately, the company can forecast numbers all it wants until the market sees proof, it's just a forecast and there's nothing really to fall back on. Let's look at the latest quarterly numbers. Again, the company is just getting started, but it's in its first quarter as a public company, sales were around $726,000. Adamas produced a loss of $6.73 million. Now, a huge percentage of the loss was from about $3.6 million in stock compensation and $2 million in warrants issued for conversion. Cash used in operations for the quarter after adjusting those was roughly $1.7 million. What is the plan here? It's to focus on its current facility, which houses 12 diamond growing machines, and get them to full capacity, at which point management believes the company will be capable of generating an average of 3,000 rough cut diamonds per month. Recently, the company announced that with its reactors at full production capacity and full marketing underway, the company anticipates more than $12 million in annual sales from its current facility, like I said, in Grenville. Additionally, management intends to make a significant investment in building out the new facility, including building as many as 400 diamond growing machines. That would be a first phase, apparently. The first phase of that, would apparently consist of installing 100 reactors, which at full capacity would be able to generate up to $30 million in top line revenue, or they believe $14 million in EBITDA on a monthly basis, or more than $300 million top line revenues with $150 million in EBITDA on an annual basis. Those are some lofty margins. Now, our take here, while the global lab-grown diamond market is estimated to have reached $26 billion in value as at 2020, it is estimated to now continue to grow at 10% from 2021 to 2030. The competition here, however, is high and growing. There are a number of companies with far more financial resources than Adamas One at present, already producing high-quality lab-grown diamonds, including a company called Element 6, which is a privately held subsidiary of De Beers Group. There's AOTC Group of the Netherlands, Pure Grown Diamonds. They're in US, Singapore, and Malaysia. WD Grown Diamonds, and a number of others, including Helzberg Diamonds under the brand Lightheart, which is backed by Warren Buffett. Now, the plans for Adamas 1 are ambitious. The company cites quality, its patent process, and insatiable demand for lab-grown diamonds as value creative for the business. The company also plans to enlist the services of prominent social influencers to further its brand, which could prove a smart strategy if well managed, but that will all take capital. Again, Adamas is lacking some at present, but the company is only in its initial stages, and it remains for us highly speculative. We monitor it, but it doesn't fit our criteria in terms of cash flow at present. That is speculative rather than investment quality at this stage.
That's interesting.
So
some grandiose plans.
For sure. And these are the companies we interview.
As of present.
Yeah. We interview and try to find out more about the businesses. This would be a very initial stage interview. So we got some information there, got some information ahead of time. Let's see if they can start to execute on that, create cash flow, and then we'll do the valuations at that point when they have some cash flow. But it is initial stages, big plans, but big competitors as well. So we have to monitor that.
Yeah, and that's like the biggest thing that I would say is like the barriers to entry to get into creating lab created diamonds isn't that high. Like, I mean, we asked them how much does a reactor cost, and they were saying about $325,000 per reactor. So, I mean, realistically, like I brought up that number to my mom, and she was like, "Wow, that's a lot of money." That's not a lot of money, Mom, for someone that wants to get into, making diamonds. Essentially, it takes them about 30 days, and they can make about 50 diamonds in one of these reactors. But that's the thing. So, low barriers to entry. We're seeing a crazy compound annual growth rate. And people need to understand too that this isn't just from cannibalization of the natural diamond or natural mined diamond market. This is actually because these cheaper lab created diamonds are basically making essentially a new market because new people are able to afford diamonds essentially, and they're being brought into. So this growth is twofold. We're seeing both cannibalization a little bit, as well as, a new market for more fashion jewelry. So my thought going forward, and I have no idea if even natural diamonds will be able to support their own price going forward, but seeing, people chasing the compound annual growth rate in the industry, the low barriers of entry, realistically, it's not proprietary technology as far as I understand. The company that we talked to, the CEO, he said that the technology is proprietary. I would argue that it's not. There are many companies out there doing
anything can be proprietary.
Their process might be.
You can just put something unique into it and it's proprietary. That doesn't necessarily mean that there's any value to that proprietary technology or that it gives you a competitive advantage, right? So everybody likes to use the term proprietary. It may very well be, but that might not mean anything.
Exactly. And, I did show Ryan this chart. So this is from Paul Zimnisky. He's one of the leading diamond analysts out of New York. And you can see here that generally the price of natural diamonds has held its ground, but we've seen lab created diamonds come down quite rapidly. Whereas people don't understand this too. De Beers has came out with a predatory pricing strategy where they're selling these lab created diamonds for about $800 per carat for 1 carat diamond US, whereas a lot of these other competitors are around, $3,500 per carat US. So, De Beers is trying to preserve that natural diamond price. Who knows if they'll be successful in it. But with the further supply that we're going to see as people are trying to chase these potential returns, I just don't see a world where as competition comes, we continue to see these generic lab diamond prices come down and down. Who's to say? As Ryan said, I do like the diamond industry. Can't say I like it for much of an investment. It's more of just my little pet project that I like following because it's an interesting industry. But yes.
And you also like to wear a lot of jewelry.
It's true.
And yes, I am blinged out at all times. Correct.
You have a diamond in one of your teeth, don't you? Yes, it's true.
No.
I almost saw it there.
He takes it out for the podcast.
It's true. That's true.
Yeah.
No, I mean, there is.
And that's the thing is that you take a tiny company like this, they look at the market as it is right now, They invest a bunch of money in these reactors, in infrastructure, and they make projections based on current prices. But if prices get cut in half, or they decline even, by a quarter, 30%, that changes the economics for those companies quite a bit. And you're right. I mean, De Beers, which essentially, from what I understand, has a monopoly almost on natural diamonds. Of course, they want to protect their market. So it incentivizes them to just flood the market potentially with man-made diamonds, and then try and differentiate the natural diamonds from that, right? Like turn artificially created diamonds into
exactly
more of a common item that doesn't have.
And right now, just to put it into perspective, too, De Beers is one of the, I think they're the second largest player. El Rosa, which is the Russian state diamond company, they have primary market share. So it's kind of an oligopoly.
In just the diamond industry overall.
In the diamond industry in general.
Right.
This is, I guess, natural diamonds.
Yeah.
Yes.
And the patented process here with Adamas one, apparently it was to produce the highest quality diamonds. Now, if there are obviously other competitors that are able to do this, and if you're talking about the machines to produce this only, costing $325,000 or under, we heard in the meeting, or under that amount. If there's another way to do this and present and create those diamonds, which as we understand there are, I'm not sure the end consumer is going to differentiate between the two. And number 2 or 3 down the road is the more that are made, if the capital outlay is only this amount, it's becomes supply and demand. If there's a ton of supply, the price of these are going to go down. And to me, I'm not certain that you can continue to have, and you've seen that Brennan put up the chart, the price is going down over time. It does seem like the barriers to entry are low. Price comes down. I'm not sure if these will be worth much. The other side of the coin too is these. They used to be marketed that they were eco-friendly. Well, the energy that goes into producing those is quite high, and they're not allowed to say now that they're eco-friendly. So they are now saying conflict-free, some of them, right, that are being produced. Yep. But again, it does look a little bit like, you look at the cannabis industry. To grow cannabis, it didn't take an absolute rocket scientist, and it actually didn't take a ton of capital. It took some, but you end up getting so much supply brought online that it crushed the market, really. So, I mean, it's not the exact parallel that's going on here, but, just the forecast from that company seemed very impressive. Whether they achieve them, we will see over time. And there's a number of factors that they'll have to fight against, and we'll monitor that.